Shall we start? Yes. So I am Shikha Rustgi, CA Shikha Rustgi, who is leading valuation practice with expert professionals. So I welcome all of you on this webinar on comprehensive approach to FEMA. Today we are on the 5th session on external commercial borrowing, which will be given by Mr. The speaker, Sushil Mehta, sir. And first of all, I would like to thanks to Sudha Bhushan ma'am, who has given me this privilege to become moderator of this session. So I thanks to her and all of you for giving me this opportunity. Now I will let me introduce the speaker, Mr. Sushil Mehta. So Sushil Mehta sir is the senior partner in Mashek Tore legal firm. He's on educational and qualification part. He is a BCom, CS, LLB, DFB, ICFAI, Diploma in Cyber Laws, Indian Law Institute, ILI, and DNNIIT. He is certified in CSR and post professional from ICSI. He is certified from Harvard Business School on Sustainable Business Strategies program. So Mr. Sushil Mehta has extensive experience of 22 years plus in corporate merger and acquisition, compliance management, foreign investment laws, as well as employment and labor laws. Sushil sir has always has been advising clients in formulating investment structures for inbound, outbound business models in automatic and restricted sectors like defense, real estate, e-commerce, print media, single and multi-brand, retail trading. He has worked in Delhi Stock Exchange, KMG group of companies, played a key role in successful venture launched by past president of ICSI. Sushil sir has also represented gamut of clients in complex and purported contraventions of foreign exchange laws, company laws, obtained favorable order from Reserve Bank of India, Company Law Board, National Company Law Tribunal, NCLT. He has also contributed various secretarial and legal due diligences on various companies engaged in different sectors. Under labor law and management area, Sushil sir has advised large gamut of clientele for formulating effective and legally acceptable labor law policy and contract, covering the aspects like leave policy, retrenchment policy, wage policy, overtime policy, dispute resolution, expatriate employment rules, processes, bonus provident fund issues, layoff termination process, and social security benefit for domestic and international workers. Sushil sir has also regularly contributed to ICSI, ICAI, PHDCCI Association as speaker on corporate law subjects and being member of their corporate law and legal affair committee. Now, I will request Sushil sir to take the session. So, Sushil, it is over to you now. You can start, sir.
Okay. Thanks a lot, and a warm welcome to all of you. Or warm, or I should say hot. It's a hot day today of May, and I must thank Team ICAI for organizing a sequence or series of lectures on the FEMA issue. Since this is a niche area, and I must say there is a scarcity of professionals in this area. So more and more professionals are required, and it's high time the institute has taken this step, and there'll be more events going forward to make members more aware of the latest developments, and we can see more and more professionals venturing into this area. You must have seen the previous presentations and the deliberations on the topic within this series, and this under current day topic, we will be discussing the external commercial borrowing, or ECB in short. I will be sharing my presentation with all of you. Are you able to see this?
Yes, sir.
Okay, I may go or switch off my camera for better quality. Just a second. Yeah. So external commercial borrowings in layman terms is simply a loan from a source which is not in India, which is an outside India. To give you a background as to what all sources are there, funding sources, and what are the regulations which regulate such inflow coming into India. As we all as professionals know, like money coming in India could have falling type of structures, like it could come as donation, it could come as investment in equity or debt or something like that. It could also come as loan, and the last is against invoice, which is very simple. Like you can render goods and services to overseas clients and raise invoices and get paid out of it, which is the simplest way of dealing with this. Then there's a donation, which is a little tricky area. You need the Foreign Contribution Regulation Act regulates such money coming in India as donations. Then there is an investment, all type of investment which is coming into India is regulated by FDI policy, foreign direct investment policies issued by Ministry of Commerce, regulated by RBI, and the last leg connectivity is provided by the ED banks, which is our normal regular banks. And FEMA and Companies Act, FEMA is Foreign Exchange Management Act, and Companies Act also has some provisions which regulate the investment as well as loans in India. For specifically loan coming from outside India, ECB regulations are there. ECB stands for External Commercial Borrowings. We'll see what is the definition, who all are eligible borrowers, who are eligible lenders, what purpose I can invite loans for, and where it can be used, what are the terms and conditions, and everything else. Against invoice is like the import-export regulations are there, so which is the simplest form of receiving money from outside India. So regulatory framework of the money coming in India is these three things you need to keep in mind. All the professionals who want to venture into this domain needs to be very regular with these kind of amendments or updates coming out from the DIPP, which was a Department of Promotion, Industry and Internal Trade, Ministry of Commerce and Industry. Implementation by RBI. So RBI does the implementation of it. They issue master circulars and master directions. There are authorized dealers, which provides the last leg connectivity to ensure compliance. Compliance heads under FEMA is liberalized remittance scheme. You must have gone through that in the last sessions. LO, BO, PO is like the incorporated, unincorporated entities which are possible in India, liaison office, branch office. This you also have seen. You also have session on foreign direct investment. There is a concept of downstream investment, which is like an indirect investment coming into in India. Then there is an ECB, which we'll be deliberating today. There are ODI regulations when you invest out of India. And then there is a compounding of offenses. Like in case there is something goes wrong, you can suo motu go to the authority and say, okay, something has went wrong and we have regularized it. Now kindly condone the delay or compound the offense. The authority has power to condone the delay or compound the offense by a nominal penalty. Basic framework, if we say about FEMA or the area where we want to practice in FEMA sector, is few points you can keep in mind for understanding. FEMA says, or you can say in nutshell says, unless specifically allowed, it's not allowed, subject to permission. So unless something is clearly written in the regulations, you can treat it as not allowed or subject to permission of the RBI bank. Most of the approvals, permissions are now delegated to AD Bank. Earlier, we need to approach to the RBI for each and every permissions. And now most of the powers are being delegated to AD Bank. We'll see in the ECB domain what all powers are with AD Bank. And it is prudent to reach out to RBI, AD Bank, compliance or regulatory team for clarification. Sometimes the language of regulations or master circular or master direction is not very clear. So it is advisable to reach out to the bank or their regulatory team for clarification, because they very often meet RBI officers. So if in their experience, there is something which RBI has laid down as an internal instructions to the bank, it will be helpful for us to devise a strategy around it. RBI, in my experience specifically, or the people who also deal with the department would feel like it's the most prudent and efficient department to deal with. You may not have anything in mind that someone will take money to do something. You can reach out to them. Sometimes definitely we have seen they won't prefer professionals to come. I think that is to create an outlook to the companies in India, like they are happy to deal with them directly rather than through professionals. But there is also a professional opportunity for us, like where you can train the client to reach out to the RBI officer, or how to be in a hearing in case there is a show cause notice, or there is an enforcement directorate hearing. So how to deal with that kind of thing can also be taught by us, and that is also a practice area we can look up to. Make your case with research and justification to secure approval. You need to do necessary research. We'll also see what is the modus operandi to check what is the current regulation, because there are a lot of notifications, circulars, guidelines issued by department from time to time, and one has to keep a watch on it. So RBI has very good system. Earlier, we used to buy manuals. We used to refer to the notifications of different dates. So now they keep on updating their original master direction as and when there is a modification therein. We'll see how to check that. Plain paper application is there in most of the cases. There is no fixed hard and fast rule that it needs to be on something. There are plain paper applications in most of the cases, unless the format is prescribed under the specific regulations. Compounding process is also very smooth, easy and economical, since the law provides for 3 times the penal consequences, but we have seen compounding process involve penalty in percentages, or in nominal percentages, or a point something percentages, which is very economical for the client to also pay and get the offense compounded. How to check the latest legal position, as we have seen, like it's prudent to check the latest legal positions. So you need to visit the RBI website, check for the relevant master direction on the subject. These master directions are updated upon each notification or amendment. The RBI website looked like this. When you click on RBI organization, there is an option notifications. On notifications, you can see master directions, circulars, draft notifications, and index. So in this, you need to click on the master directions. Post master directions, you will see master direction under each kind of category, like banking, non-banking, financial market. So a relevant area for us is foreign exchange management. And under that foreign exchange management, you can see the master directions issued on different subject. So the relevant subject now today we are discussing is the first one, which is the external commercial borrowings. And you can see that original direction is issued on 26 March, which get updated from time to time. And the latest amendment being done on December 10, 2021. So every time the RBI issue as a notification or amendment, these master directions get automatically updated in this section. So every time you have any confusion or you want to check the latest position, it is advisable to check the master directions of the current date, or add this option to see like you are within the law, or what does the regulation of the date tells you about the issue. Now coming to equity versus loan, as the topic says, external commercial borrowings, we since our study days have seen the debate between the equity versus loan. There are pros and cons for the both type of options. And these are the 2 financing options available to the company to raise equity. Go for equity financing or debt financing. Debt financing involves borrowing of money, whereas equity financing involves selling a portion of equity in the company. Main advantage of equity financing is that there is no obligation to repay the money acquired through it, because the rule of equity is you run with the risks of equity. So there is no fixed return on the equity if you are thinking, or there is no guarantee the money will come back to you. So equity financing places no additional financial burden on the company. However, the downside can be quite large. And the main advantage of debt financing is that business owner does not give any control of the business. In addition to this, since in case you have an huge equity, there will be many regulations which get applicable on you. Vis-a-vis loan, loan is in. So the debate is on. So what type of option you are, depending on the business model of the company or the financial accruals of the company, you can decide on what is the best model for the company as equity versus loan. If we compare the commercial loan interest rates, this is an indicative list of some of the major banks providing corporate loans in India, and you can see the loan ranges from 11% to 24, 27%, which is a big rate of interest. So ECB provides a very low range of interest, so it becomes very attractive kind of a financing option for companies in India. There is a lower rate of interest in the range of 4 to 6%. We'll see how and why this 4.4 to 6% gets applicable. But when you compare it with the commercial loan as against 21 to 26 or 11%, it's like a huge difference. Debt equity ratio can go up to 7:1. That is like for every 1 rupee of equity, you can bring 7 times the loan into India. End use restrictions are now very minimal. Earlier, it was only open for some of the limited sectors like manufacturing, hospitality, hospitals, and all that stuff. But now with the liberalization or more modifications coming in the regulations, and you can now even use it for working capital or general corporate purposes, which is a very good option for companies or the startups which wants to avail equity, which wants to avail funding without leaving the equity to the foreign hands. Easy conversion of loan and interest into equity is also possible. So you can structure a transaction where initially the loan can be given, which can later be converted into equity at the option of either the company or the investor. Within group, parent subsidiary relationship, or by individual shareholder, it's possible. There are certain conditions when a shareholder can give a loan to an Indian company. But yes, as in within group company structure also it is possible. The documentation is easy, and nowadays many of the banks provide specific assistance to Indian companies in case they plan to invite ECB from the shareholders or from any other foreign source. Approval for most of the case issues is delegated to AD Bank, so you need not go to RBI in all the cases. And there is a big limit, USD 750 million per financial year every company can avail within, and the limit is also per financial year, so it could go a multi-fold if you are planning to do it, you can say year-on-year basis. This is the increase in the inflow or the net ECB over the past few years. The first figure is of 2017-18 when there was a lot of restriction on ECB funding. Then they permitted many more sectors into the arena, so you can see the jump. Then obviously the COVID era was there, so there is a lot of reduction, so there's little money coming in or going out. So and the last one is the provisional figure. So when we say external commercial borrowings, what we mean? As literal terms or as per the regulation, we can say ECBs are commercial loans raised by eligible resident entities from recognized non-resident entities and should abide parameters such as minimum maturity. So there is a concept of minimum average maturity period. We'll see how it is computed and why it is relevant. Permitted and non-permitted end uses are there. And there is also a maximum all-in cost ceiling. So when you talk about ECB, these 4-5 concepts you need to keep in mind. It will be a loan, obviously, and there will be some eligible entities. There will be some eligible recognized lenders, and there will be some conditions we need to fulfill to avail ECB from a foreign source. Form of ECB, when we see ECB or a loan could have a different kind of an structure. It could be simpler as bank loan. It could be fixed floating notes, bonds, debentures. Here we may need to keep in mind, as you may have known from the previous structures, is like anything which is fully convertible into equity is treated as an FDI or as an equity investment, but anything which is partially convertible is treated as in the nature of a loan, right? So anything which is partially convertible is treated as an ECB, and you need to follow the guidelines of an ECB while issuing any such instrument to a foreign party. Trade credits beyond 3 years. So it is also relevant. We have seen many cases where there are trade credit or advances given to an Indian entity which runs due to certain circumstances beyond 3 years. So regulation says if there is a trade credit which runs into more than 3 years, then it will be treated as an ECB, and you need to follow the ECB norms. Foreign currency convertible bonds and foreign currency exchangeable bonds are also part of the ECB, and financial lease is also ECB. Financial lease runs in the shipping and the airline industry specifically. So who are the eligible borrowers? So here the good news is, or the latest thing says, all entities who are eligible to receive FDI are eligible to receive ECB as well. It includes companies and LLP as well. So all companies who can receive ECB can also receive loan from a foreign source. Even the not-for-profit entities who are engaged in the microfinance activities can also avail ECB from a foreign source. Other entities which are permitted to avail ECBs are port trust, units in special economic zones, SIDB and Exim Bank for further funding to their beneficiaries. Who are the recognized lenders where I can avail the loan from? So lenders should be resident of FATF, FATCA, if we have heard of, they need to declare a declaration. So FATCA is Financial Action Task Force is there, which lists down certain countries or certain entities who comply with the international norms. And there is a IOSCO, International Organization of Security Commission, and it should be the lender should be from the compliant country. There are countries which are not compliant of this. We know Pakistan, and there are certain other countries which are not part of these compliant countries. So while inviting funds or while advising on the structure, you need to check the lender's country, where they are coming from, or what is the background from where the funding is supposed to come. Multilateral and regional financial institutions where India as a member country is also recognized as lender to Indian entities. Foreign branches, subsidiaries of Indian banks are also permitted as recognized lender for foreign currency ECB. FCY ECB is a foreign currency ECB when we say. Foreign equity shareholder is also recognized as a lender. But the condition is like he should have a direct shareholding of minimum 25%. So if you have a body corporate or an individual who is holding a 25% shareholding in your company, they can bring in additional funds as loan to your company, which can be used for working capital or even general corporate purposes. Or alternate ways, there is an entity which is indirectly holding minimum 51% in your company, or a group company where there is a common parent which holds minimum 51% shareholding. So foreign equity shareholder is also eligible as a lender who can give as a loan to Indian entity under the ECB norms. A limit and leverage. So limit of funding per financial year, as we have discussed, is a huge, which is USD 750 million per financial year, which is approx 57 plus billion INR. If one has to see it from the INR terms. If from direct foreign shareholder, debt equity ratio need to be maintained as 7:1. Not applicable where the outstanding or proposed ECB is up to USD 5 million. So if the limit to be availed as from foreign source is less, this 7:1 is also not required to be maintained. But some entities which are in which the sector specific requirements are there, like for example telecom or banking or something, where there is as per the licensing conditions they have a debt equity ratio to maintain, so they need to follow that also as part of the ECB policy. All-in cost ceiling. So what is an all-in cost ceiling? All-in cost ceiling includes rate of interest, other fees, expenses, charges, guarantee fees except withholding tax, if any, on the loan. So in layman terms, all the cost associated with raising a loan is capped and said to be all-in cost ceiling. For foreign currency ECB, so difference between foreign currency and INR ECB is not a bigger one. Foreign currency ECB is when you are using the loan for meeting any foreign currency expense. And INR ECB is when you receive the money as converted into an INR. So only difference is of like how you want to utilize the money overseas or in India converted into INR. So in the loan agreements, you can accordingly mention basic principle here is who runs the risk of financial exchange change or the currency change. Like for example, if you have agreed for say 750 million INR loan, then for you it will remain always 750 million INR. But in case you take a foreign currency loan of 750 USD, then based on the exchange rate, it keeps on fluctuating. So your loan is accordingly keep on changing, or the overall amount which is due to a foreign party keep on changing. So for foreign currency ECB, the all-in cost ceiling is benchmark rate plus 500 basis point spread. Basis point spread is basically 5%. 100 basis point is what is treated as. So what is a benchmark rate? We will see to it. But for foreign currency loan, benchmark rate plus 500 BPS, and for INR, it's a benchmark rate plus 400 BPS. Like for example, 4.5%, 5%. Benchmark rate. Earlier, the benchmark rate was LIBOR. 6 months LIBOR. The regulations specify like you can check any 6 months LIBOR plus 500 basis point is overall ceiling on the cost. But this has recently been changed to ARR, which is alternate reference rate. We'll see why it's been changed also. But as the regulations stand today, you need to check 6 months tenure of ARR, and most prominent ARRs are Euribor, SOFR, SONIA, ESTR, Saron, and Toner. We'll see what these abbreviations stand for and applicable in what type of loans. But you need to keep in mind, like you need to check 6 months. Say, for example, if you talk about Euribor, say for 29th April, it was minus 226%. So all-in cost in such a case will become 0.226 minus 0.226 plus 5%, which is 4.774. So maximum interest payable or the maximum cost on such loan would be approx 4.7% or 5%, so to say, as against the commercial loan which you avail in India is to an extent of 12 to 27%. So it's a huge difference. So if you have a foreign shareholder who is ready to fund as loan, it's a win-win deal for Indian companies to get such money on such interest terms and avail benefit of the ECB policy. Even for the prepayment charge or penal interest, there is a cap of 2%. So any such penal charge or prepayment charge cannot be more than 2%. Sorry. As we said, there is a shift from LIBOR to ARR. So in 2005, there is some allegations of manipulation on LIBOR or the London Interbank offered rate. It's been done by the regulators and to give benefits to some of the banks or to the transactions. This come to the light in 2012. After this, there is an intercontinental exchange which took over the LIBOR management, and there was an alternate reference rate committee which was formed to replace LIBOR and to lay down the transition plan by end of 2021. So internationally, all the reference rates are now being recognized and or being taken as alternate reference rate of relevant currency. Earlier, the standard was LIBOR, which was referred by all international transactions. In December 2021, RBI has also made necessary changes in all the regulation to switch from LIBOR to ARR. So now the ARR relevant for all ECB transactions are these, as we discussed, Euribor, SOFR, what these stands for. So SOFR stands for Secured Overnight Financing Rate. It's used for USD loans, and it's administered by Federal Reserve Bank of New York. You can check it from their website, or if you check it Google it, then you'll find the reference rates for all these currencies. So probably for the transaction, parties can decide what alternative reference rate they want to pick, depending on the market conditions or depending on the currency they may be. Like for example, for GBP loans, SONIA is referred, which is Reformed Sterling Overnight Index Average, which is managed by Bank of England. There is SARON, which is Swiss Average Rate Overnight, which is used for Swiss franc loans, and SIX Swiss Exchange manages that. Toner is Tokyo Overnight Average Rate, which is used for yen loans, and Bank of Japan manages that. Euribor is used for euro loans, and it is a Euro Interbank Offer Rate, and it is managed by European Central Bank. So this is a recent change, and all we need to be aware of, like what is the reference rate for them. The point relevant here is for INR, the reference rate is government securities, Government of India securities yield of corresponding maturity. So for INR loan, the benchmarking is the government raised corresponding maturity interest rate, and this is normally the government bank yields or the securities issued by the government from time to time for relevant maturity. End uses, certain end uses which is allowed now are working capital purposes. This is very rare because earlier there was restricted, and ECB were only allowed for new projects and expansion or development, and only to the manufacturing industry or hospital and hotel industry. Now it is available to all, and even for the working capital purposes, and even general corporate purposes, even for paying salaries, so to say, and even for repayment of rupee loans. So the restriction on the end users has been lifted. So it becomes very attractive and go-to kind of an option for the Indian entities. Certain things which you can't do with ECB, or ECB cannot be used for real estate activities. So there is a definition of what real estate activities means. In layman terms, buying and selling of real estate is something which you can't do. It excludes purchase of, say for example, you have an office, you have a company in India and you want to purchase office for it or land for it. That is something which you can do. Real estate activities in layman terms is buying and selling of land to earn profit. So there is a clarification by RBI and DIPP on this subject, and that has also been included in the regulation now, which provides an exclusion for you are buying land for modernization, expansion of existing units construction, or integrated township, industrial park, for infrastructure. So this is something which will not be treated as real estate activities, but otherwise the ECB will not be used for buying and selling of land for the motive of earning profits. Investment in capital market is also a restricted end use. You can't use the ECB funds to invest in the capital market. Equity investment, you can't do further equity investments with the money you have taken as loan. On lending to entities for above purposes, you can't use the money to give in further loans, but this exception is there for NBFC. So for example, there is an entity which is NBFC who received an ECB for further funding, which for NBFCs it is allowed as an end use. For other entities it is not allowed, like you can't use ECB for further funding. Now is the minimum average maturity period. So this is the minimum which you need to keep as average maturity period of any loan. We'll discuss what are the caps, then we'll discuss how this MAP is computed. So manufacturing sector, if you are taking any ECB up to USD 50 million, the minimum average maturity is 1 year. So you need to repay after 1 year only. You can't repay before average maturity period. So this is a cap on the minimum average maturity of any loan. So you need to run this loan for these many years and only can repay or convert after these years. So if you have availed loan for working capital purposes or general corporate purposes or repayment of loan from foreign equity holder, then minimum average maturity is 5 years. If you have taken it from any other lender, the minimum average maturity is 10 years. Similarly, if you have taken rupee loan availed for capex from foreign equity holder, the minimum average maturity is same, 5 years. But if you have taken from any other lender, it is 7 years. And for NBFCs, the limit is 10 year and 7 year respectively. So MAMPs need to be strictly complied in all circumstances. So you need to keep in mind when you are making a drawdown and reimbursement schedule or repayment schedule, you need to see in case of any changes in the drawdown or repayment schedule, the MAMP would get changed. So for any change, you need to again go to the bank and inform them like there is a change. So you need to ensure that your maximum minimum average maturity period is maintained. Otherwise, you will be at risk. So call and put options also, if there is any under the agreement, is only exercisable post expiry of MAMP. So how it is computed, it's a simple illustration if you can see, but you may need not go into the calculation of it. The bank normally share with you the Excel sheet. You just have to put a figure, but for understanding, it is an weighted average computation of the days for which the money is with you. And say, for example, the first is the table date of drawal, and drawal amount is there. The column third talks about repayment. So if you compare first and third column, the drawdown has happened on 5th of November, and repayment for that is happened in somewhere in 2008. So you need to compute how many days you are the funds were with you. So number of days balance with you is computed at column number 5. Then you compute a minimum average days 360 and taking the total year days as 360, and accordingly compute the and when you add up with the different tranches, you'll come up with the minimum average or average maturity. So this you need to keep in mind, like your this calculation should fit into the regulation, and in case your average maturity calculation is not as specified under the, so you need to change your date of drawals or repayment schedule to meet the minimum average condition. Hedging and security, and again on the MAMP is like you need to be very sure, like and you can advise your client accordingly to structure their drawdown and repayment accordingly. Sometimes clients want it to be very frequent. Since there are compliances attached to it, you can advise them to have a gap between the tranches so that the compliances can be minimized. But and there is a buffer with the companies and even for the foreign company to remit the money into India. If they are very frequent, you may need to have because the calculations goes backward, and you need to ensure the money of drawdown happens on that day only. If there is a change, your calculation of minimum average maturity period get changed. So that you need to keep in mind while advising the client. Hedging and security. So hedging and security is basically optional, but by concept, hedging and security means you are running a loan which is into a foreign currency, so which could change later on. And there is an option the companies can keep a hedge on it, where they minimize the risk by paying a premium and fixing the rate of repayment with a third party entity or even with the lender. So hedging concept is there. So it's not compulsory, but most of the companies which avail loans in foreign currency go for hedging to avoid foreign currency exchange fluctuation risk. Similarly with security is not mandatory, especially in the foreign currency loans from the shareholders of the group companies. But you can create, an AD is authorized, AD bank, your regular bank is authorized to permit creation of charge on immovable assets as we normally create for any domestic loan. There are certain conditions which banker need to see if you are meeting that. that underlying ECB is in compliance with the extant ECB guidelines. There exists a security clause in the loan agreement. So we'll see what all you need to keep in mind while drafting a loan agreement. The no objection certificate from an existing lender, which is very normal in the lending industry. In the event of enforcement, this is important. In case of an enforcement or invocation of charge, for example, there is a default and foreign party wants to invoke the charge. So what will happen to the property which is charged to a foreign party? The regulations say it need to be sold out at India level, and only the funds can be repatriated outside India. So foreign party by default doesn't get an ownership of the asset in India. It will be sold by the Indian party, and then the proceeds will be repatriated to liquidate the outstanding ECB. Process to avail ECB. This kind of give you an overview of how to structure or how to plan the documentation part of it. For availing ECB, obviously first and foremost step is to identify a lender. In most of the cases, we have seen the foreign party as shareholders are keen to. Otherwise, there is a vacuum because there are not many lenders which are easily available to lend at this rate of interest. But we as professionals can assist some of the companies or some of the lenders to identify, because if you talk about international markets, even getting 4 to 5% is a huge rate of interest, because internationally they don't have a practice to give that huge interest as India has it. So they are keen to give in India, but they are looking for different consultants or advisors who can suggest them the good corporate entity who can ensure the repayment at a given point of time. So obviously, once you have identified a lender, what all you need to do is with the documentation is the loan agreement is the first next thing which you need to execute, or you can say have draft executed. Basic understanding between the parties get executed as an MOU or you can say term sheet. As part of the documentation to the AD bank, you need to send out a request letter for allotment of LRN. LRN is a loan registration number. And then there is a loan agreement you need to affix, in which the transaction documents you need to say, for example, as against loan agreement, if you have any MOU or any other like debt instrument document, you need to attach that. You need to have a detailed drawdown and repayment schedule annexed to a loan agreement. It's advisable to get annexed, because if it's a form part of the loan agreement, you need to amend the loan agreement every time. So it's recommended to be annexure to a loan agreement, because it can be submitted separately to the bank as well. And if every time you are changing an annexure to a loan agreement, it's easy to change that rather than changing the whole loan agreement. Every change in the drawdown and repayment schedule require intimation to AD bank, which is relevant as we have discussed, because any change in the drawdown and repayment schedule also changes the MAMP, and the banks and the RBI regulations are very strict about it. Plan to utilize the ECB funds to permitted use. So you need to be very ready with what you will do with the funds. Obviously, there are options of working capital and general corporate purpose. So for documentation purpose, you need to give a tentative kind of an indication or table as to suggest like how you plan to utilize the funds for the duration of the loan. For example, there are drawdowns happen every year or every 6 months. You need to say like, okay, what percentage or what quantum of loan is being used for a general corporate purpose, and within general corporate purpose, what you plan to do, like pay rentals, pay salaries, any other expenses which is contemplated. So that description you need to give it to the bank to see whether your end use is within the permitted thing, and obviously there is a certification also attached to it. So you need to be sure of what the funds will be utilized for. Board and shareholders approval. This is relevant from the corporate governance practice also, and as well as part of the transaction thing. There needs to be a board approval both for approving the loan transaction and also for opening a bank account, separate bank account, to park the ECB funds. So what happens when you apply for an ECB application, bank opens a parallel account for you for the ECB thing, and the money for ECB get credited into that, and you can draw down from that account for the purpose you have listed down. And it's a good practice to have it, because you won't mix the funds in that account. So, and bank, it's easy for the bank also to track like what all money has come in and what all money has gone out for. You also need to attach average maturity calculation sheet, which will be provided as a draft by the bank. You need to fill out the sheet based on your own drawdown and repayment schedule, so to calculate the average maturity in the given case. There'll be a certificate by practicing CA and CS, which is like a summary sheet of an ECB on the form ECB itself, which basically tells like all the regulations being met, and what are the percentages, what is an all-in cost ceiling, what is the MAMP. So a professional like you and me need to certify that like this transaction is as per the ECB regulations. There is a CS certificate also required to say like all the regulations with respect to the Companies Act, FEMA has been complied with for the given transaction. There is a declaration and undertaking by the vendor or by the entity also to say like they are not in the negative list of FEMA, or they will utilize the funds as per the ECB regulations. So there is a given format which the party needs to sign, but essentially the declaration undertakings talk about the compliance of the FEMA provisions. You also need to give list of shareholders to identify what is the percentage of holding of the shareholder which is a lender in the given case. Otherwise also to determine what is in shareholding percentage of the company, to determine who are the key controller of the company. There is also debit authority letter given to the bank, because some banks charge some processing fee on such loan, so they'll debit it from the bank account you are maintaining with the bank. Post this, once the bank vouch for everything they need, they'll forward the application with their recommendation to RBI, and post review of the RBI will issue LRN. So loan registration number, and this letter is very important. You need to scrutinize this letter, very, very important. We'll see what are the catches in there. Once the LRN is issued, you need to report the actual transactions in ECB2 on monthly basis. So this is a regular compliance which every company which has availed ECB needs to make. In this, you need to specify what all funds has come in and what all the money has been used for. Important pointers, as we have seen discussed, like there are certain points you need to be very clear about and needs to keep in mind while reviewing the transaction documents, or probably suggesting or advising the client. Date of loan agreement and date of first drawdown. So what happens normally is there is definitely a different date for both of them, because obviously parties are executing a loan agreement today and drawdown may happen 3 months down the line, 6 months down the line, as per the feasibility of the parties. But effective date of loan from the banker's perspective or from the RBI perspective is the date of the loan agreement. So even if your drawdown happens 3 months, 6 months down the line. So try to have a balance between the two, so that otherwise you will need to file the nil returns for the missing period. Or missing period means like from the date of loan agreement to the first drawdown. Say for example, date of loan agreement is May 2022, but your drawdown happens in August. So from May to August, you need to file probably ECB2 return, which looks a little weird, but for the justification bank or the RBI people will give you is like, for them the effective date of loan is a loan agreement, and which is there. So you need to be very sure of. Sometimes you can also structure in such a way or do a backward calculation while submitting the documents to the bank is you can keep the drawdown as close to the loan agreement, or probably 30 days, 60 days down the line, so that you may need not file multiple ECB2 in that case. Drawdown and repayment schedule frequency, as I have discussed, like you can advise the clients to structure the drawdown and repayment frequency as very feasible for them. If they keep it very regular, like per month kind of thing, it will be a little tricky for them to meet the deadlines every time, because they need to probably depute a team or a person to regularly manage or arrange for, because there will be backward calculation for each drawdown and repayment thing. Right. Also, you can have if you can advise the client to bring in the big chunk of funds in one transaction, so that they have a buffer of 3 to 4 months in between next transaction takes place. Because if you are doing it very frequent and there is any change or any delay in the drawdown or money hitting Indian account from the foreign account, there will be a change in the MAMP, and probably you need to report that to the bank. Obviously, this is within the AD power, but the additional documentation and compliance kick in for that thing. LRN letter issued by RBI. So this, as I have told you, you need to be very categorically check the LRN letter issued by RBI, because that normally specify the start date of ECB2. So as I have told you, they take the date of loan agreement as effective date. So probably the letter may ask you to file ECB returns starting from the date of loan agreement, or probably immediately thereafter, irrespective of the LRN issue date. Say, for example, you have a loan agreement date of May 1, and you may get LRN letter by, say, end of June. Probably, so you need to file it for May and June as well, irrespective of the letter or LRN date, letter date. You need to file the ECB returns for the last 2 months, and that will be a nil return, obviously, because there is no drawdown within that period. Loan currency, this is also important to advise to your client from the perspective of what the funds are required for, and obviously from the foreign exchange fluctuation risk, like who owns or who wants to keep that risk of whether foreign party wants to keep that risk. They can accordingly. This needs to be clear in the loan agreement itself. Like you need to specify whether it is 5 crore INR or 5 crore dollars, and throughout the documentation you need to follow the same currency. Or you can mention approx INR, but that is irrelevant in the case, because at each repayment and each drawdown it will be accordingly changed. Normally we recommend foreign currency, because in that case your drawdowns and everything else remains constant for all documentation purposes. But obviously, depending on the transaction documents and the purposes or the risk which party wants to take, you can keep INR or foreign currency as convenient to your client. Foreign shareholding restructuring, this is critical from the point of view of where the existing shareholder does not own the 25% shareholding, or whether there is a shareholding and different companies hold it. So probably this restructuring should be done before the loan transaction documentation is done, and you can advise the client accordingly. Like in case they are little low on the 25%, you can raise their shareholding, or probably from the group company which is ready to do the funding. So this restructuring you can advise to the client to have in place, so that ECB can be availed from a foreign shareholder. Fund utilization, whether so queries whether I can keep an FD on it. Yes, very much possible. You can, within your ECB account, keep an FD for the tenure you don't need the funds for. Say, for example, in your utilization schedule, you have the funds on day 1, and that is for next 3 months or 6 months as per the repayment schedule. And so for that 3 months, 6 months, you can keep an FD on it, and the bank can give you interest also. So that will add on to your kitty, and you can utilize the funds for the company. Security is again obviously depending on the transaction and as agreed between the parties. So can you have unsecured loan? Yes, very well you can, but obviously you need to see the transfer pricing and other regulations also kick in. But yes, within shareholders, within group companies, within parent subsidiary relationship, you can have an unsecured loan as well. All-in cost ceiling also you need to keep in mind. So panel charges is 2%. So that you need to let your client know, like in all circumstances, it will be this much. So you can also advise on what ARR to keep, so that to have the client okay on that. Like for this currency, we are using this one because now the window is open for us to advise the client. Otherwise, earlier it was LIBOR, so there was no option. But now, you based on the currency, you can choose the alternate reference rate as suggested by RBI. Important pointers for the loan agreement. This we have discussed, like loan amount and currency. Loan amount is also, it's kind of an backward calculation, or what tenure you are looking at and what type of structure the entity has, or what purpose you need the money for. You can advise the client accordingly to have a buffer accordingly, like whether if the client has calculations of X amount, you can add on to it to meet any unexpected expense or for any further future expansions and all. Because once taken, it will be added on if you want to change it on later on, and it's better to have a buffer so that you can have excess funds from the foreign party and repay as per the schedule. Purpose is also something which you can advise the client. You can use it for, now it's very wide. You can use it for working capital, general corporate, tenure, and all these points should match in your documentation. So bank will check essentially these points in your loan agreement. So this should tally with your other documentation. Sometimes in purpose, the client or the drafting team may mention something else, but you need to ensure that the all documentation, if you are taking it for working capital or general corporate purpose, at all places it should mention the same. Same with the tenure. Sometimes we mention the days, sometimes we mention as years. So it should ideally talk about as in schedule, and schedule should refer it to the MAMP calculation. Drawdown and repayment schedule is also, as we have discussed. So this should match with your loan agreement as well as the transaction documents or the application you will be filing with the RBI. Any change or any mismatch therein may delay your process, so you need to check that. Interest rate is also, like sometimes we mention prevailing market rates or some other rates in the loan agreement, and in the ECB application you will mention something else. That is also get raised by RBI or by bankers and delay the process. Security is also something which the banker would check, because they have an authority to approve any creation of charge on immovable asset by the borrower in favor of the lender. So that needs to be specifically checked, whether your loan agreements provide for any security within that. Default and penal clauses is also something important which you need to keep in mind while structuring the loan agreement, and also the bankers will specifically check what is the consequences of a default, because obviously the cap is there, like penal charges cannot be more than 2%, but you need to see what are the other consequences which falls in the loan agreement, and accordingly advise the client. There is a late submission fee for delay in reporting. So this also you need to keep in mind while filing, because this ECB2 return has to be filed by 7 working days. So usually it falls on the 9th of every month. So 7th working day of every calendar month, you need to file the ECB2. So you need to do that backward calculation also, like by end of the month, you should have everything, so that in the first week itself, you can file this ECB2. To filing ECB2, you will want from the client the utilization kind of an statement, like what the money has been used for, because accordingly you will get the certification from NCA or FCS accordingly and file it with the bankers. In case there is a delay, and the period of delay is up to 30 calendar days from the due date of submission, specified LSF is 5,000, and this LSF is specified to avoid compounding or default cases due to delay in filing these forms. So this is also something which you can file and close the matter then and there, rather than waiting for delay notices or show cause notices from the department. So by default, when you file it with delay, the banker will ask you to submit a LSF DD and accordingly take your ECB on record. So a further delay, say for example, up to 3 years, this will get trigger in where transaction by default falls into the ECB category, or there is a change in the management or the people who are taking care of, and there is a total mismanaged thing. So if there is a delay of such nature and it goes up to 3 years, there will be a 50,000 per year kind of an LSF which you can pay and regularize the default, which is a better way to deal with it rather than going into the compounding thing. Similarly, if you want to go and there's a case of beyond 3 years from the date of due date or drawdown, then it's a 1 lakh per year kind of a fixed LSF which you are required to pay. Powers delegated to AD banks, as we have discussed, majority of the powers are now with the AD banks. So they can approve change in the name of the borrower or lender. Say, for example, there is a change in the entity which is earlier a borrower, or probably change within the entities who are borrowers, or the entities who buy out the existing assets or the loans of the company. So that type of changes even bank can approve based on the documents being submitted with them. Transfer of ECB is also something which banker can approve, subject to complying with the minimum average maturity and other conditions of the ECB thing. Any other parameters of the whole transaction, AD banks are having the powers to approve, obviously subject to compliance of the ECB. So if you are complying with your ECB things like minimum average maturity and all-in cost ceilings and the end use and everything, the bank can change or permit other variations or changes. Like, for example, there is a change in the drawdown schedule, or there is a repayment schedule, or there is a lender name changing, or security being changed. So that all is within the bank. Even the AD bank, change of the AD bank is also permissible. A no objection certificate is generally obtained from the existing bank. That is to ensure that nothing is outstanding and they clear off their file and hand over the file to the new banker. Cancellation of LRN is happen generally where there is no drawdown against the said LRN and monthly ECB's returns are submitted till date. Then the AD bank can permit the cancellation of LRN also. Refinancing of existing ECB is also something which is permissible, and the conditions applicable are outstanding maturity of the original borrowing, and weighted outstanding maturity we compute in case of multiple borrowings is not reduced, and all-in cost fresh ECBs lower than the all-in cost of the existing ECB. So if this condition is met, even the refinancing of existing ECB is something which AD bank can approve. Conversion of ECB into equity, it's a good option where you can structure the transaction as like initially the funds being given as loan, and later on it's been converted into equity to give a buffer to an Indian entity to use the funds as loan and then get it converted into an equity. Most of the new startups does that to get a funding buffer. Conversion of ECB, including those are matured but unpaid, into equity is permitted. Even the interest component which is outstanding on that can be converted into equity. So the conditions applicable in such cases is the borrowing activity of a borrowing company is covered under the automatic route or approval route, or approval should have been obtained as per the FDI policy. So the entity sector needs to be checked, because obviously FDI policy needs to be complied whether the company which has availed the loan and getting it converted into equity should be as per the FDI policy. It will be either under automatic route, or if approval is required, necessary approval would have been taken for allotting equity against the loan outstanding. The conversion should be with lender's consent and without any additional cost. Should not result in contravention of eligibility, breach of applicable sector cap on the foreign equity holding under FDI policy. Applicable pricing guidelines for shares are complied with. This is something which FDI policy provide for. Now it is any international accepted formula. Earlier it was DCF, so discounted cash flow method. Now you can have any internationally accepted practice or calculation to come out with the valuation of the shares and get the shares allotted on the date of conversion itself. In case of partial or full conversion, you need to accordingly report on ECB2. So while filing the FCGPR, it needs to be reported in DSIM, and in Form ECB2 as well, you need to mention with suitable remarks as ECB partially converted to equity, right? And in case of a full conversion, the narration goes as ECB fully converted into ECB, and subsequent ECB Form 2 are not required in such cases. Fair value of equity shares to be issued shall be worked out with reference to the date of conversion only. So there was little queries or investigation, or people come to know like by what conversion rate or on what date I should take it, whether it should be a date of agreement or probably date of the initial funding which I have availed. So this has been provided for in the regulation is like it will be of the conversion date itself. So you need to accordingly compute a valuation of that date. Security of ECB, as we have discussed, AD banks are permitted to allow creation, cancellation of charge immobile assets, and they need to see that necessary conditions are met. They also check the security clause in the loan agreement. What does it say? And requiring borrower to create, cancel charge in favor of an overseas lender. No objection certificate. This point we have discussed from the existing lenders is normally taken. There is a special provision for startups also. Startup as defined under the central government regulations, and there is a special policy for startups. And similarly, there is a carve out being made in the ECB regulations as well. And in such cases, the minimum average maturity period is fixed as 3 years, and recognized lenders are same. And foreign branches and all will not be considered as recognized lenders in such cases. Otherwise, all other eligible entities are keen to make the ECB loans to the startups. Maximum 3 million USD is something which is allowed as per the policy for startups per financial year. And there is no restriction on all-in cost ceiling. It will be mutually discussed or agreed between the borrower and lender. And uses is also for any expenditure in connection with business of the borrower. So this is also like something as an extra for the startups. Conversion of equity is also something which is freely permitted. So, but startup, in case they want to go beyond 3 million, or probably they want to change the MAMP, then they have to come under the normal ECB policy rather than availing the ECB under the startup category. Other borrowing related, so there are regulations which also regulate borrowing between the Indian entity and other foreign entities, which are specifically between the person resident in India and NRI and POI. So which regulates between the individuals basically. Which says like a company may borrow INR from NRIs and POIs on following terms. These regulations are different from ECB regulation, but since these are also regulating the borrowing at India level, I have just tried to capture it and try to give you a glimpse of it. But normally it happens between the NRI and their interest in Indian companies. So just for the sake of clarity, you should have this, like this option is also there in case in trio transaction, the person is an NRI or person of Indian origin who wants to do funding in India level. You need to check the Indian company does not and shall not carry out agriculture, plantation or real estate business. Here again, the real estate definition is the same, buying and selling of land for the motive of earning profit. Trade in transferable development rights and act as Nidhi or chit fund company. So you need to ensure that your company, Indian company, is not doing any of these, or probably they need to give a declaration that they will not do anything like this in future as well. Borrowing is issued by issuance of NCDs, non-convertible debentures. and the issue of NCD is made by public offer by the Indian company. So, the rate of interest in that case is prime lending rate of SBI as on the date in which resolution approving the issue is passed by the borrowing company in general body meeting, and there is a buffer of 3%. So these are the specific regulations where the Indian company is issuing NCDs for the public offer to NRIs and POIs. So they need to comply with these conditions. Carry forward provisions are restriction on the use of borrowed funds. For these regulations specify like it will need to be used only for own business. Construction of farmhouses will also not be permitted. Restriction on real estate does not include development of township, construction of residential commercial premises, not to be used for investment or for on lending in the matter whatsoever. RBI may, however, permit to use amounts so borrowed for on lending to infrastructure sector. This exception is there for infrastructure sector, but not for other entities. And there is a filing requirement also that you need to file within 30 days of receipt of funds. Full details of the remittance received, list containing names and address of the NRIs who has made the investments. So this is a specific requirement for the companies who are receiving funds from NRIs and person of Indian origins. Some FAQs which we generally receive, or probably our friends normally ask, or the client normally asks, like whose responsibilities, ECB compliances are whose responsibilities. So regulations are very clear, it's borrower's responsibility. So borrower need to ensure that there is an ECB filed at regular thing and there is an approval requirement, or LRN is in place and all that thing. Whether LLP can receive ECB? Yes, since May 2011, LLPs are made to invite FDI. So all entities who can receive FDI can also receive ECB as per the amended norms. Can the foreign shareholder dispose of the foreign of the holding post ECB? So which means like for the regulations, the foreign shareholder need to hold 25%. So ideally the question is like whether they can dispose of post ECB funding. Answer is no. They need to maintain the exact shareholding throughout the tenure of the ECB. So this is a special provision for them and facility being given. So the regulation says they need to maintain this shareholding during the tenure of the loan. Can the interest accrued on ECB be converted? This we have said yes. So you can convert the interest outstanding on the loan to as a part of equity conversion. Can drawdown of ECB take place before LRN? This you need to be extra cautious. No payment, no commission payment, no drawdown should take place before LRN, or you should not instruct your foreign lender or foreign party to initiate the payment unless an LRN is there. Because even in the remittance instruction, you need to mention the LRN, and your banker would definitely wants LRN before they can get credit the funds to the account. So it is recommended to have it post LRN issued, otherwise it will be treated as a non-compliance. What to do for changes in ECB terms between lender and borrower? So a revised ECB form is filed with the bankers and not later than 7 days from the changes. And banks normally take that on note and issue a letter for that. Can we pay commission or service charge before LRN? Its answer is no. No payment should be made before obtaining LRN. Property consultants can avail ECB. This is a tricky thing. As we said, the real estate definition says buying and selling of properties for earning profit. So there is a clarification asked by some of the property consultants like Cushman and Wakefield and others in the area to RBI, and RBI has specifically clarified like the property consultants can't avail ECB. Conversion of foreign currency ECB to INR currency possible at exchange rate prevailing on the date of the agreement between the parties. However, vice versa is not allowed. You can't convert INR ECB to foreign currency. This is basically to limit the foreign exchange outgo or exposure to Indian economy. So conversion from foreign currency to INR is possible. Reverse is not possible. Borrowing in INR by Indian company from NRI POI, whether ECB. This is regulated as per the borrowing, as we have seen there are separate regulations for NRI and POI, PIO. So these transactions are not regulated by ECB, but they are regulated by the master directions specifically issued for this purpose. ECB proceed means for foreign currency expenditure can only be parked abroad. So what happens normally is when you are availing ECB for meeting any export payments or import payments and all, so you can park it overseas. You need to open a bank account there and you can keep the ECB proceeds there and meet the expenditure from that account. Whereas if you have availed rupee ECB for rupee expenditure, it need to be repatriated immediately after drawdown at India level. ECB proceeds can be parked in a fixed deposit for a maximum cumulative period of 12 months with the AD banks. So it is not from the date of the drawdown. Any cumulative period for which the PC proceeds can be kept is 12 months with any of the AD bank. These are some of the clarifications or the things coming out from the practice or the experience. Deemed ECB, you may have heard this at many of the compounding orders or probably from your friends and clients, there is in case of a deemed ECB. Although this deemed ECB is not something which has been defined under the regulation, this nomenclature is basically used to refer the transaction which are in the nature of a loan from the foreign party to Indian party. So examples could be like there is an advance outstanding in the books which is outstanding from longer duration, amount due but not paid, intergroup adjustment or outstanding. So you need to be very extra cautious if you find out any of these transactions or amounts in the balance sheet of the client. You can raise out because there are timelines under the import and export regulation within which you need to pay the outstanding or receive the money from outside India. In case you are not meeting that and the funds are being kept, and generally this we have seen in intergroup companies and where the funding arrangements are there to have the amount outstanding for long for the. So in such cases, if being noticed, the RBI can issue a show cause notice of ECB violation. And so generally it's been recommended to get the same adjusted, because once pointed out or once being raised as a violation of ECB, you need to do both, like ECB compliances for the period it's been outstanding, and also get the things compounding under that thing. Even if you want to get these converted, say for example, I may say like there's an outstanding balance, I want to get it converted into equity, then also you need to take a post facto approval for ECB violation and get the compounding, then only you can get the amount outstanding converted into equity. So this is a nomenclature which is used to define the transactions which are in the nature of a loan but not invited or not in compliance of the ECB regulations. There are a lot of opportunities for professionals. As in the starting we said, this is a niche area and there's a lot of professionals who are desired or wanted by the clients at the right time and right places. So there's a lot of opportunities. You can provide advisory assistance and drafting of the ECB transaction, not only for ECB, for whole FEMA, I must say. Professionals like you and me can definitely assist them, because we need to have the knowledge of the FEMA provisions as well as the Companies Act as well as the tax and accounting structure, so that we can advise them accordingly to structure the transaction and accordingly take the benefit of the regulation under the FEMA provisions. So you can advise them on transaction documentation. You can provide them assistance or finalization of the loan documentation, drawdown and repayment schedule, and related annexures, drafting, or probably advisory on how to structure them, rather than just following the normal practice. You based on experience can let them know what is the frequency you can keep or what is the ideal way of structuring the same. You can also advise them on security, creation, registration, and enforcement documentation in case involved in the whole transaction. There is also a vacuum, which I must say, between the borrower and lender entities, as I have started in saying in the starting. So you can fill the gap of that coordinator between the lender and borrower and the AD bank in the whole process. So sometimes the borrower and lender decide something in between themselves, and when they apply for ECB thing, they come to know different things from the AD bank. And also we see as a gap between the ECB arranger. Like sometimes clients reach out to us, like whether you can help us in arranging an ECB from the international sources or international lenders. So that is an area where some of the professionals who are already into the lending field, they can think of, you can say, having some international lenders who can fund Indian entities on ECB policy norms. You also can advise them on regular and event-based compliances of the ECB provisions, which is very relevant in this case and become very frequent as against other compliances which are quarterly or half yearly. In this case, it's a monthly thing, so you need to advise. You also advise them, or you can say help them in issuing a certificate for ECB compliance on monthly basis, which is required from a practicing chartered accountant or a company secretary. Which specifically says the funds are being used for the purpose and the compliance has been made for the FEMA provision or the ECB regulations. In case there is a requirement of an RBI approval or compounding, you can help them in documentation processing of an RBI approval in the case of a fresh application or in the case of a compounding matter. These are some of the opportunities just to highlight some of the area within the ECB domain. With that, I think we are well within the time. We can definitely take up the queries. I must say there will be very much queries. We'll share this presentation with all of you on the group itself, and my contact details are there. I would be happy to assist you with your queries if you have any. I'm also on LinkedIn. You can reach out to me there, and we'll definitely catch up. There are many more sessions which Institute is going to conduct. So we are hopeful that it will create an awareness among the professionals, and more professionals will enter into this domain. With this, I think I'll open the floor for the question answer. I'll stop sharing.
Yeah, just a minute. Let me read the questions. Just a minute. First question is, can you tell me the difference between ODI and portfolio investment for outbound investment with an example?
This is not related to ECB, but to let you know, the ODI regulations is regulated by the ODI thing, and the rest is managed by the SEBI. So there's a difference, definitely, but yes.
Fine. Next question is, Indian subsidiary or foreign company, foreign parent company can. I don't know, it's incomplete question. It is written by. Just a minute. It is written down. Second question, Indian subsidiary company or foreign parent company can purchase property for self-use, either from loan from foreign parent company or infusion of equity.
Yes, this is permitted. So Indian subsidiary company is as good as an Indian company, and it can purchase land for its self-use for making office or factory or something else. Only restricted thing is real estate activity. So real estate activity is defined as buying and selling of land for the motive of earning profit. So you are buying something, a piece of land, and then you sell it after 6 months or 1 year to gain profit out of it. That is something which is restricted. But else, otherwise, you can purchase land for making your own office and use it for the self-use.
Okay. Third question is, to whom the CS certificate is to be submitted?
The CS certificate is to be submitted to the banker along with your ECB application, and on monthly basis, the certificate is submitted along with ECB2 to say the compliance of ECB provision as well as the loan documentation is being done.
Okay.
So the repository in this case is the AD Bank. We need to file everything with the AD Bank.
I think I will go to AD Bank only. Fourth question is, if the company fails to file ECB2 return, is there any penalty leviable on AD Bank, or RBI will deal with AD Bank separately?
We discussed this. If the company fails to file ECB2, there is you need to pay the penal charges, as we have seen,
yes,
SMF and all. AD Bank is, I think, question has two parts. So one could be the liability on the company, and other they are asking about the bank. So bank are collectively required to file all the ECB they have funded or returns they have received during the month on monthly basis to RBI on their internal platform. So obviously they are under onus from the RBI to comply with that. In case they default, there is an liability on them.
Yes, definitely. Just a minute. Next question. Before commencement of LSF, the only possible route was of compounding. For an earlier offense before the LFS period, how to go about compounding? Kindly guide.
Yeah, in these cases, what you are rightly on that point. Like now, for the introduction of the LSF, it's very easy to get the delay compounded. But for earlier cases, you can also reach out to your bank, give the case. They'll put forward this case to RBI for order of the LSF. If RBI is of a view that this is a genuine delay and there was no malified intention, they will issue you a letter for filing or depositing an LSF for the given period and accordingly condone the delay. So you can get the LSF order for the earlier filings as well from the RBI, and AD Bank will assist you to pursue that case, and they will definitely need to make sure that this is a genuine delay and there was nothing malified kind of thing in the whole structure.
Got it. The next question is, what about a NRI partner putting in more money than his capital?
What about a NRI partner putting in more
NRI
money?
Partner, can a NRI partner be part of this ECB?
I think they are talking about LLP, because LLPs are something which they can do. So LLP agreement is there, in which there is a specified what the structure of the funding would be from both the partners. In case they put in more funding, there will be, as per the LLP agreement, if LLP ask about a loan, then definitely that will be as per the ECB thing. So they need to structure it accordingly, whether the LLP agreement talks about loan from the partner or capital. If it will be a capital, that will be an additional capital from the partner itself, as per the LLP agreement.
Okay. Can the ECB proceeds be parked in any other instrument other than FD?
Thinking aloud, only FDI is something which is contemplated. Other is like, you can't invest in security market. Yes. You can't invest in real estate. So yes, there is no other use which you can do it with. You can only park it to make any payments to your vendors. So easiest is the FD.
Okay. Next is, sir, if we have funds idle more than 12 months, is required to be made as per extant RBI guidelines. FD is allowed maximum 12 months. Can we renew the FD post 12 months and continue to comply ECB guideline and save negative carry forward?
No, this is something which is allowed. So cumulative period of 12 months is something which is allowed, and you can renew FD for 12 months period. So that is possible.
That is, you mean allowed. Okay.
Yeah.
So next question is, what kind of compliance is required in case of borrowing from NRI and PIOs?
Which this we have discussed. There is a separate direction for that. In that case also, there is a return which is required to be filed within 30 days with a list of NRIs and the POIs and the amount they have invested and the type of instrument and the amount involved. So it's kind of a similar return, but it's regulated as per the different direction, not as per the ECB thing.
Okay, then what is the name of the return then? Any idea?
Sorry?
What is the name of the different return you are talking?
There is no return, name of the return, but the regulation says the return is to be filed. So it's a return to be filed.
Oh, okay, okay. And next question, an overseas wholly owned subsidiary take loan outside India and compliances in India under FEMA.
No, see, whole framework you have to see. The FEMA provision will get only trigger in when the money is coming in India or going out of India, right? So if anything is happening outside India, FEMA provision will not get applicable. So overseas WOS taking loan outside India is something which that entity, obviously the foreign entity is a separate legal entity. So they need to comply with their applicable regulation of that jurisdiction, not of India.
Okay. Next question is, you mentioned that professionals can syndicate ECB with foreign lenders, but one of the criteria is that the lender has to be an equity shareholder in the borrowing company. Is this correct, or any other route available?
So foreign shareholder is one of the lender category. Other categories are foreign institutional who can invest, who can give loans, even foreign banks or the branches of the international banks or the Indian banks. So that is the other eligible lender category. So equity shareholder is one of them. So in that domain, you can act as a syndicate or act as a coordinator between the foreign entity lenders and Indian lenders. Obviously, in case of a shareholder, the party will definitely decide in between the further tranche of funding is to come as equity or as loan. In case of loan, they need to follow the ECB thing.
Okay. Next question. As far as I am aware, FCGPR reporting is not required in the event of full conversion of ECB into equity, as it is not FDI. Is it correct, sir?
No, FCGPR will be filed because you are issuing shares. So if you see the FCGPR format, there is a column which says what is the mode of funding. So in that you need to mention conversion of ECB into FDI, into equity. So that column is there. So definitely FCGPR is filed. Otherwise, how will you recognize the equity into the company and the conversion of loan? So after filing of both the returns will be filed in ECB2, you will be mentioning full conversion of ECB into equity. And in FCGPR, you will mention the source of funding as ECB conversion, ECB and the interest outstanding on that conversion into equity. So that will be treated as an equity, and the company, thus RBI will issue you a registration certificate for that equity. Otherwise, it will be a limbo in between, like whether it is a loan or an equity.
Okay. Is there, next question, sir, is there any limitation on number of compounding application a company can make with RBI?
No, they can do multiple, but only thing need to be checked. If you are making a compounding application for the same offense again and again, then it will not be, because one of the condition of compounding thing, you give a declaration that you will not do this offense again. So you need to be extra cautious of what the compounding application, but otherwise there is no restriction on multiple compounding application for different offenses. You can also club all into one also.
Okay. Okay, fine, sir. Let me see if there any other question is there. I think all the questions are done. Covered.
One question I can see is the last one, I think 14th one.
Because just a minute.
It says, if a security deposit received from foreign buyer company having common directors as Indian seller for new project, foreign buyer company having common directors. Okay, should it be considered ECB? If security deposit received from foreign buyer company. The query is not clear. Probably they can get it connected with me offline so that we can discuss it. But yes, if there is something which is outstanding in the books of accounts for several years and not being paid, and this is due to a foreign entity, you need to be extra cautious, because any one of the regulation will get trigger in. Because if it's against the goods and services, it need to be repaid, or the goods and services need to be delivered within the given timeline. If it's something else, could be treated as a loan to the whole transaction. So that as consultant or as an advisor to the organization, we need to be extra cautious if something is there in the nature of outstanding against or in favor of a foreign party.
Sir, one more question is there. So if a CCD is converted, then who FCGPR is required?
Yeah, of course.
Okay.
CCD is compulsory convertible debenture. So when you convert them, you need to file FCGPR saying what is the ratio in which the conversion has happened for each CCD, what type of shares is being issued. So there's a lot of reporting needs to be done for that as well. Yes.
Okay. Any other question? I think all the questions are covered. Krishnan, sir, any other question from audience? Anybody want to ask any other thing, any other point? They can come forward and ask if they want. No more question, I think.
Okay, great. But I am available otherwise also on the Telegram group we have. So I'll request members, in case their questions are unanswered or they come up in future with some queries, they can definitely reach out to me. I'll be happy to help them out.
So, sir, I would like to take this opportunity to do this vote of thanks. So seriously, this was a very good session. Very simple, easy language, and seamless flow. Even it was like anybody who is attending it first time, they will also understand it completely. So you have covered everything, like basic structure, how to read the directions, what are ECB, why to take ECB, what are the pros and cons for taking ECB, and what are to cover in all-in cost ceiling. How to calculate maturity. The table was very good. I mean, they're very helpful, because that is one major thing to be covered while reporting, filing the return also. So, and other pointers to be checked while taking this loan, and from AD bank also, like what has to be checked from their side. So that was also like very nice and very helpful. So other coverage like late submission fee, because this is something which all the practitioners should know. Like if there is delay in filing the return, what are the penalties the company is going to pay? So this is something very important thing. All the practitioners should know. And you have covered startups, which is in very much there in India. Because most it is new venture, and many of the companies are going. So this is a new thing, taking the loan through ECB. So what are things to be taken care while if it is a startup company, or if you are conversion, and again you are that part conversion of ECB into equity. That was really excellent, because that is helpful for all the practitioners. Because whether they are they're in practice, or they are their own clients, or they are doing their themselves. So this is something which is every client is coming through this part. And your last thing is coverage of FAQs, which has cleared all the doubts, whatever things were there. So it was excellent session, very interactive session, and I think. Complete coverage of ECB, end to end. Everything is there. Very nice, very well explained with examples. Very nice, sir. Practical point of view, it was very good. Very nice. Thank you very much for your time, sir. Thank you so much for this excellent session.
No, it's my privilege to be here and share my knowledge and experience with fellow professionals. This we owe to our institute to share knowledge as we gained in our lifetime post qualification, and it is like coming out of mainly from the experience we have from the transactions we did, like what all bankers normally check, what type of objections they normally raise, So we as professionals should be aware of, and when you go to the client, feel confident, like, okay, yeah, we can handle these type of transactions. So client also feel, you can say, yeah, okay, we have reached out to those safe hands and the person can help us out. So I think that's something which, as in confidence, we need to bring in as in professionals, and show in our conduct and knowledge with the client, so that client have confidence, like, okay, they can deal with us. So that is something as in taking point. And FEMA is an interesting topic and field where people can, and there are related fields like foreign currency, Foreign Contribution Regulation Act, where the money is coming as donations. So that is an also niche area where nowadays you have seen number of cases there. Latest is the Xiaomi news you may have seen, where although it appears that they have made the payments outside India legitimately, but there is definitely an enforcement directorate investigation, and pursuant to that, there is a freezing of accounts. So obviously, once you are struck at there, ideally, our approach should be like the company, the case or the matter should not go out of hand. It should not reach out to the ED level, because once it reaches the ED level, you have a limited control. At RBI level, you can definitely meet out to the officers, discuss the case, convince with the relevant filings, and also accept the mistakes if there are any, or non-compliances or delay, so that you have an options to get that regularized, rather than going under the ego thing and saying, no, I can handle, or there is a documentation to prove. So it sounds sometimes easy or logical to go against the regulation, but once it goes to a level where it comes into a media, it will become a very huge thing for the company as in brand issue or as an image issue. Like there is a non-compliance, and at that level, it's a serious offense then. So we as professionals definitely needs to pitch in and help the client wherever we can.
Yeah. And your session has covered everything in that way.
Okay, thanks. I know I have tried to, because
very helpful.
No, I definitely kept it that way, because I know that there will be some professionals who are at the starting stage of it, and there will be professionals who are already advising the existing clients. So for the starting people, or for the niche or the initial stages of your professional career, you need to have the understanding of the basics, right? So and as an expert, you also need some practical tips of like how the things happen at the ground level. Obviously, sometimes we have read these all provisions and sometimes we know the law, but when it comes to a ground level, when you meet the bankers or when you meet the regulator, there is a huge difference, as we have seen in our practice. So definitely that helps to discuss with other persons who are already in the market and dealing with such cases. No, it's a pleasure, and I think it's a good initiative by ICAI and led by Dr. Adukia ji. He's an I think inspiration for all who are in the industry, and Salim sir would also say the same thing. And we have seen number of sessions earlier also, and it's very interactive and very knowledgeable sessions. And faculties are also good, which part on the knowledge to the concerned people, and I think more and more people will get attracted to the field and gain knowledge out of it.
Definitely, sir. And nothing is left. I think everything you have covered so nicely, and it was so simple. It was looking very simple, like easy to understand. Any person who will start, who will be doing practice for first time, or maybe involving first time for any transaction. So it will be very helpful for them to understand the transaction, to start the procedure. So really, it is very good.
Thanks a lot.
In fact, you could see there are 808 people who are viewing this program now, which is really a good amount.
Good.
And I'm sure these participants would encourage the other participants also to come in.
Yeah, of course.
And join these programs. So, by this conversation, I would also request on behalf of Chairman Sir, Dr. Rajkumar Adukia Sahab, that please popularize the such programs, and not only popularize in terms of participation, popularize in terms of being speakers. so that, we have the knowledge from the, people who are practicing, who have the expertise of what they are doing over here. So it was a lovely session. I was all ears. And thank you so much, sir, for giving your time over here.
Thanks a lot. I think.
Thank you once again, and now we will keep troubling you. We keep ringing you.
No issues. Most welcome. I'll be happy to be there.
Because I told you that I'm in valuation, so definitely will convert for conversion purpose or something. When some assignment will come, I will definitely.
Sure. Definitely.
Thank you
Thanks
so much for the session once again from all our audience.
Although there is a time, I think we can conclude, or should we wait for further queries? In case there are further queries, I'm happy to address.
In fact, I would suggest, if you have something to, really give, because these last 10 minutes can also be more valuable, because we still have, participants who are there, the same numbers. So if you have something which you want to tell them, if you want to, give inputs apart from what you presented in your screen that you shared with us.
I'll share one good incident probably. FEMA, if we talk about, it's a part of our whole syllabus of the student days, and the funny element happens. Normally we skip this because as in part of the whole structure, we'll see like, okay, this is only carry some minimum marks, and the coverage is huge because obviously FEMA is a big subject. But once you read it, you will find like the structure is very simple. As I have told you in the initial thing, the whole framework of the law is like, if something is allowed, it will be specifically written. Otherwise, if it's not written, you can definitely advise the client that it's not permissible or subject to an approval, which is in like very good structure of a regulation, because this is come out of an example or once FERA was there and after that FEMA was come. So the perspective of it's more of a management rather than putting into people into behind the bars. And the concept of compounding is also very, very good, where because sometimes people do say, okay, there is a non-compliance and we are unable to comply, or there was no one to advise the client accordingly. Obviously, ignorance of law is a no excuse, but since the management or the company is more involved into the business, they may not know about the nitty-gritty of the compliances every time they are receiving funds, and funds could be of any nature and they may not know, because there are instances where the client would have received funds from the unknown source. So now the onus is on the bank, like they can't credit the amount in the client's account unless they take a declaration from the client, like what is the purpose of the funding. Otherwise, earlier what happens was, it was the money get credited from an unknown source, or the client is now at fix, and they are in non-compliance because they even don't know who is the supplier or who is the funding person. And the KYC requirement was there, and the people will get struck up in that kind of an arrangement. So with the framework of it, each section is different. And now with the technology upgradation, earlier we recall, we have read and have multiple manuals of FEMA. Now within technological upgradation, the website is so dynamic that all amendments get updated on real-time basis, which is also very good. So we can refer in case of any confusion. If the client, you receive any query and you have any confusion, you can just reach out to the master direction section, read out the relevant direction, and you will definitely get answers, or probably somewhere hint of like where I'm heading to. Then second stage is obviously you can reach out to the bankers and their regulatory team. Now many of the multinational banks has their dedicated regulatory team like HSBC, HDFC and Axis. So you can reach out to their regulatory team, because definitely they have dealt with such cases in the past. So they can give you a real view from their experience. And in case they are also not aware of, definitely third stage is you can reach out to RBI, put a written clarification kind of thing, or reach out to them and think. So in RBI, there is a time window where you can go and visit the offices, and it's Tuesday and Thursday normally, 3 to 4. And you can make a pass and visit the officer. There is a section called FDE, Foreign Direct Investment section. You can reach out, and the officers are demarcated based on the alphabets of the companies. So you just have to tell the name of the company for which you have come, and accordingly they can guide you to the relevant officer. You can meet the relevant officer, discuss the case in case they have, generally they already have read the file, so they can highlight you like what is the missing thing, or they also advise the client or consultants like what should be done in such cases. Like they will advise you on the face of it, okay, there is a default, you go for compounding or make this kind of an application where we'll put the case for a compounding, then on a one hearing you can get it resolved. This kind of an advisory also they provide, unlike other departments, like what to do, how to do. They say, okay, you are the professionals, you deal with the case, we don't know. So this is something which is very appreciated for fresh professionals, I would say. Otherwise, you can also guide the client like what should be dealt in a particular situation. But this support is provided, and obviously because FEMA or the regulation is such, it promotes foreign investment into India, and it increase the foreign, I can say, resources of Indian economy. So it's a important regulation, and many companies are now coming in India and receiving foreign investment, especially the new startups. So this is something, a good area where everybody can think of venturing into, and do receive queries from the clients where they pitch into a foreign vendor or a foreign investor who wants to invest into the Indian company. So with this, I think this is again as a niche area, and you can definitely venture into it. There are many professionals who are ready to advise you, guide you on that area, and the regulator is also very easy. Some people feel like they won't allow professionals to visit them. There's a different story behind it, like why they don't. They prefer the clients to come in directly, and that is also one practice area we can. The real example is like we taught one client how to appear for an hearing before an RBI, and we charge for it. So I feel like that was more than what otherwise I would have charged if I would have gone directly to an RBI officer. So obviously client is little skeptical how to deal that kind of an inquiry or investigation or a notice being received from an RBI. So you can teach the client like what all probable questions could be, how to deal with that kind of questions. So that is also one area where you can think of venturing into. So this obviously comes from the experience and practice, and practice makes one say perfect. So that is with that, I think more sessions coming your way in this domain will help you to expand your knowledge base in this domain. With that, I think we are happy to close this. I'll be sharing this PPT on the group so that you can have a reference material, and you can reach out to me in case you have any query.
Yes, definitely. So by this, we
so
will.
Sir, yeah. Sorry, please.
No. Sir was telling something.
You can share the screen in between, sir. You can share the screen in between.
Sir, thank you once again. So we will wind up this session. We will conclude it. And with this.
Okay, thank you all. Thank you all for attending this session, and look forward for the mutual. Yeah. Okay, Salim sir. Okay, thank you. Thank you, Shikha ji. Thanks a lot for moderating the session.
My pleasure, sir.
Thank you.